Hello friends, let's admit it. Last week when you saw this video, the thumbnail of which you're seeing on your screen, you thought I had lost it. I was losing the plot, or maybe I was even trying to mislead you into believing that the market was going to be bullish. But the market actually rose with the Nifty rising almost 4% and the Bank Nifty rising almost 5.5%. Who done it? How did it happen? In this video, we are going to discuss all this and more. And I'll also discuss whether this kind of an up move is sustainable, what are the threats and opportunities for you in a market like this. Friends, I'm Vijay Bambwani. I'm a trader. I've been trading these markets since 1986. And in my videos, I'm going to help you become better traders by understanding the market nuances much more better. Let's dive right in. On your screen is the market roundup window, wherein you're seeing that the rally was led by the banking space because the Bank Nifty rose 5.5%. The Nifty 50 brought up the rear by rising 4%. We saw risk appetite for financial assets increasing. That can be brought out by the fact that gold and silver fell. Oil and gas were basically subdued. Oil actually fell, whereas gas saw a mild rally because the market seems to be getting over the shock effect of the Eastern European war. The US dollar index, the currency benchmark of the United States, also eased marginally, which is a good thing, which I've explained to you in my past videos for all emerging market economies, including India. And the USD INR, the rupee versus the dollar, also saw the rupee strengthening versus the INR to the extent of 1%. 10-year benchmark bond yields eased 4 basis points, and that tells you that the bond markets also were marginally relaxed. This was the second week where the NSE gained in market capitalization successively, which is again another good thing. The market-wide position limits rose, and that is along expected lines because up to the expiry, at least the third week of the derivative cycle, MWPL manages to rise. The overseas cues were also fairly positive. The Dow Jones rose 5.5%, Nasdaq gained almost 8.5%, and the Standards and Poor's rose 6%. Most of it was late buying in the second half of the week, especially after the US Federal Reserve decided to hike just 25 basis points, which was less than what the market feared, and therefore the market cheered it. Now on your screen is the MWPL daily chart, which shows how the MWPL is climbing steadily, which I told you is the routine empirical evidence that we've seen so far. Look at the weekly chart of MWPL now. I promised my viewers I would bring as many weekly charts of my in-house exclusive studies as far as possible. And what you are seeing is the weekly chart of MWPL. This is a revelation. I have told you that the derivative cycle up to the third week of a particular cycle witnesses MWPL rising. This is exactly what you're seeing, camel-like humps every 3 weeks. And on the fourth week, there is a peak out, and then the MWPL crashes on expiry day. Now, the first thing that comes to your mind, and do note this is a weekly chart spanning 20 weeks, 4.5 months. Gone are the days when MWPL used to hit 30, 31, 32, 33%. Now, being a weekly chart, these are figures only of Fridays. But in the week before the expiry, before the last Thursday of the month, MWPL used to go up to 32, 33, 34% also. Those days are passé. All right. So the two marshmallow guys. And what is the marshmallow theory? You will see in this video. It's there in the description. It will also show up in the end screen. You can, below the description, get a URL to this. The two marshmallow guys are clearly not as gung-ho as they used to be 3 or 4 months ago. Now let's see the daily chart of the individual stock and index futures turnover. On a week-on-week basis, in spite of the fact that it was a short week to the extent of one holiday, the turnover rose in both index and stock futures. Now, this is the daily chart. That tells you that there was more enthusiasm from the one Marshmallow guys. Do refer to the Marshmallow theory video. All right. Now, the two Marshmallow guys are hesitant, but the one Marshmallow guys are showing higher degree of participation. So when you see that video, you will be able to interpret this chart better. Now let's take a look at the weekly chart of individual stock futures and index futures. You can see that we are somewhat in the upper end of the range of both the index and stock futures turnover. So the one Marshmallow guys, the intraday traders, seem to be participating in the market just fine. Now let's take a look at the basis chart of the Nifty and the Bank Nifty. The first one is the daily chart, as it says 20 days. Now take a look at how the Bank Nifty basis has almost come to zero. We are not into negative zone yet. So in spite of the fact that the rally was led by Bank Nifty, the risk appetite from the two Marshmallow guys seems to indicate a compression. So even though the Bank Nifty has gone up, they are either selling at higher levels to book profits or they are going into hedges, which is why the premium has eroded. Relatively speaking, Nifty's basis remains rock solid. So between the two of them, I think comfort lies in the Nifty 50 rather than the Bank Nifty. Let's check the weekly chart. I told you I would share weekly charts with you. Here is something that should excite a medium-term trader, somebody who looks at things from a broader perspective. Look at how the Nifty basis has been rising continuously for the last 4 weeks, whereas the Bank Nifty basis rose from zero only to collapse. This tells you that the pullback rally in the banking stocks apart, the strength is actually building up in the Nifty 50 rather than the Bank Nifty. Now, this is of course a 4.5 month view, which gives you a much bigger perspective, and therefore it's well worth the effort to put in weekly charts here. Friends, let's now go to the advance decline ratio. Here you can see that after the truncated week where we had one holiday, the advance decline ratio managed to stay above 1. And the fact is that it closed above 1, which is a very positive indicator. Now take a look at the 20-week chart of the advance decline ratio. This is again a good thing to see, because what you are seeing that for 2 consecutive weeks, the advance decline ratio has been above 1.5. All right. So here you are. Again, the advance decline ratio is a gauge of one Marshmallow appetite. The one Marshmallow guys are doing fine. It's the two Marshmallow guys who seem to be hesitant from a behavioral finance point of view. Now let's take a look at the impetus chart. Now this is the daily chart of 20 days of impetus. You can see that the curve, the slope of the Nifty 50's impetus is much more steeper as compared to the Bank Nifty. But the Bank Nifty curve is also sloping upwards. And the last 2 trading sessions for the Bank Nifty saw the impetus rising, whereas for the Nifty 50, we saw the last 2 trading sessions actually saw the impetus zoom. So the fact is that the last two days' rally was built on some kind of strength. It's not without any backing at all whatsoever. Now take a look at the weekly chart of the impetus. Since the last 2 weeks, the impetus on the weekly chart is actually falling where the Bank Nifty is concerned, and for the Nifty, the impetus is actually rising smartly, which is why I told you earlier, looking at the basis chart, that traders seem to be a lot more comfortable going long on the Nifty rather than the Bank Nifty. Now here you have it. The impetus chart bears it out as well. Let's take a look at the LWTD chart. I believe many of my viewers are a little confused and they are misinterpreting the LWTD chart. What you are seeing on your screen is the daily chart. We'll then switch to the weekly chart in the next screen. What you are seeing is that the Nifty, representing the blue line, has risen. It's above zero. Now do remember, this is a differentiating aspect about my chart here, is that the Nifty is not being shown as an absolute value. This is the percentage gain or loss, which is GL. Percentage gain or loss in the Nifty versus the percentage gain or loss in the LWTD. So if the Nifty rose 5% on day 1 and rose 2% on day 2, the Nifty chart, the blue one, will actually show a decline. If you were to take a look at a conventional bar or candlestick chart, it would show a continued up move. But here, this is a percentage change. It basically is measuring velocity of the Nifty. So the velocity of the Nifty on Friday over Thursday seemed to have flatlined, but the LWTD, which again is a percentage velocity of on a broader perspective of many more, it's an amalgam of many more studies, has gone into negative. Does it mean that the market will collapse? No. It's just the percentage decline in the momentum, in velocity. All it does tell you is that the price is still headed higher, but it is likely to experience a drag. To understand the interpretation of the LWTD indicator, you must refer to this video. The hyperlink to this video is in the description segment below the current video itself. Friends, let's take a look at the weekly chart of the impetus now. Now, this is again revelatory because you're getting a 4.5 month perspective on your screen. What you are seeing is that week on week, the Nifty has risen for a fortnight. Do remember my last weekend's video was prescient and fairly clairvoyant in its advice that the Nifty was likely to go up. See how the Nifty has shot up on a week-on-week basis, but the LWTD is below zero even on the weekly chart. Not only is it below zero, but it is making lower peaks. So what is really happening? I've actually sent out a WhatsApp alert to people who are on my WhatsApp broadcast list. You can feel free to send a message on the number on the screen that you're seeing to be included in this free feature of ours. You can basically get a lot of gyan and market interpretation insights at regular intervals. And I sent you the reason why, even though the broader market seems to be sluggish, the headline or frontline indices are still gaining. So this is an explanation that the drag factor may see at some point in time that the Nifty might encounter selling at higher levels, but I'm not saying that the market will crash for now. Do remember that the March magic, which I talked about in that WhatsApp message, still holds. Does it mean that the market will continue to rise ad infinitum in perpetuity? No. You know, when the LWTD indicator is coming down and the market is rising irrespective of that, it basically exposes the market to the vulnerability of the butterfly effect. Now, this is a video that I have made explaining what the butterfly effect is. It was recorded a fairly a couple of quarters ago, but as relevant as it was when I recorded it. The hyperlink to this video is also in the description below this video itself. Now, the markets are more vulnerable today to the butterfly effect than at any other point in time, but by no means am I saying that they are about to crash. Continue with the flow, but just cut back your exposure and be very, very careful about how you maintain your stop losses without fail. Friends, I now go to the footprint of the four category of traders. We start with the FIIs, who basically increased their individual stock futures net long positions along with their index longs. Index, they were actually net short last week. They are now net long. So FIIs seem to be gung-ho in the derivative space. Where DIIs are concerned, they've reduced their stock futures net shorts drastically over the last couple of trading sessions. And where the indices are concerned, they've stepped up their net short positions week on week. Where prop traders are concerned, now this is very, very revelatory because these are brokers. They are second best to insiders because they know who's buying and selling, and they tend to front run the overall market momentum. They've cut their long positions in individual stock futures to the lowest in many months, and they are net short in individual, in index stock futures. They've actually increased their short positions week on week in index futures. Now let's see what the retail guys are doing. Now do remember that the retail segment has been doing all the heavy lifting and has been responsible for majority of the up move in the market. Now the retail has simply dumped their index futures net longs by almost 75-80%. And what they have done is increased their individual stock futures net longs by maybe 10,000 lots. Not much. 9 to 10,000 lots. Not much. So where prop and retail are concerned, these guys are not really very gung-ho, which is why I say that the market is vulnerable to a black swan, a butterfly effect kind of a event occurring at any given point in time. Friends, I now move to the bond market, which basically saw a higher degree of comfort because oil prices came down. The market seems to be drawing comfort from the fact that the rupee is relatively stable versus the dollar, and oil prices at the pump have not been raised. So inflationary concerns, or fears rather, seem to have eased a little bit. So far so good. The bond market is okay. And if the bond market is okay, the other asset classes also tend to be a lot more quieter. Moving on to the US dollar index, the benchmark of the US dollar vis-a-vis a basket of global currencies, we saw that there was profit taking at higher levels, but the Dixie is still respecting its bullish trend line and is staying above a 25-day exponential moving average, which is a proxy for 1 month holding on cost of an average bull. So the short-term outlook remains positive. Let's take a look at the weekly chart, where the last candle is a fairly prominent bearish candle. Here again, the price remains above its 25-week exponential moving average, which is a proxy for 6 months holding on cost, and therefore the medium-term outlook also remains optimistic, but for now. Now, last week I advocated a range between 100.40 on the upside and 97.80 on the downside, which was breached marginally because the low made was 97.71. I missed it by 9 paise. All right. But there was a huge amount of volatility, war, etc., a collapse in many industrial metals in the commodity space. So that 9 paise is a plus or minus of a very small magnitude. The coming week should see an estimated range between 99.60 on the upside and 96.90 on the downside. This is something that you need to watch out for because it will impact your commodity, currency, and equity markets, and emerging markets are likely to be impacted more than the developing world. Friends, I now go to the Bank Nifty, which gained almost 5.5% last week. And what we saw was that this index rose on 3 out of 4 trading sessions last week, and it has closed above its 25-day exponential moving average, which is a proxy for a month-long holding on cost of the bulls. Now, it does not mean that the bulls are suddenly above water levels. It's just that the recent buyers are now seeing some amount of profits coming in. Guys who've held on to their long positions, which were rolled over month after month since the last 3 or 4 or 5 months, are still underwater. But for a start, this is good. Do remember the two oblique slanting trend lines that I've drawn like a fan. Last week, I talked about the bump and run reversal, the bar, BARR reversal, and the kind of resistance of the bump and run reversal will come at approximately 38,000 levels on the Bank Nifty. Early days yet, but this is what the chart is indicating for now. Turning to the weekly chart, we see that the index is basically just about below its 25-week exponential moving average, which is a 6-month holding on cost of a bull. And that's where it has halted last week. Will it cross over this week? If yes, I think the bulls will see a respite, a relief rally, wherein at higher levels, as we approach 38,000 plus levels, there might be unwinding from weak hands who are scared after having seen levels of sub 32,500 also, and they are now waiting in the wings to exit. This is a concept that's called overhead supply. When people trapped at higher levels want to exit. So in the week before last, this index was at number 1 of the most volatile list. And I told you this is not a good thing, that benchmark index being the most volatile traded instrument in the market. Sure enough, it fell 1 notch to number 2. And last week, I advocated a range between 36,475 on the upside and 32,600 on the downside, which basically held perfectly well. Now, in the coming week, I expect a range between 38,350 on the upside and 34,500 on the downside. Friends, the Bank Nifty done. Let's go on to the Nifty 50, which gained almost 4% on a week-on-week basis, as you can see on your chart. It has also rallied on 3 out of 4 trading sessions. The triangle pattern that I had indicated since the last couple of weeks is now overcome, and the market has gapped up on Friday to close significantly above its 25-day exponential moving average, which is a proxy for a month-long holding on cost. And therefore, just like the Bank Nifty, the recent buyers are now out of the woods, and they would basically be drawing comfort from the mark-to-market gains that they are making. And therefore, the selling might halt for a while, only to accelerate as we get to a round figure mark of 18,000. I'm not saying that we are getting there, but that's precisely what might happen if we do get there. Turning to the weekly chart, you are seeing a second consecutive bullish candle on the Nifty 50, and that too a fairly prominent one. All right. The closing has been above its 25-week exponential moving average, which is a 6-month holding on cost of the bull. So the Nifty, as you can see, compared to the Bank Nifty, is earlier in giving back the price to a medium-term buy and hold bull. So relatively speaking, the chart of the Nifty is better than the Bank Nifty. And of course, the impetus also told us that. The basis chart also told us that. This is not to say that the Bank Nifty will collapse. All I'm saying is, in relative percentage terms, safety lies in the Nifty 50. All right. Now, in the week before last, this index was at number 10 on the most volatile list. It rose 2 notches to hit number 8. Now, this is not exactly very great because higher volatility can cut you both ways. Last week, I advocated a range between 17,300 on the upside, and it basically exceeded that by hitting a high of 17,344. And on lower levels, I expected a decline between 15,950, which wasn't really tested. So the upside was exceeded by 44 points only. In the coming week, I expect an estimated range between 17,975 on the upside and 16,600 on the downside. Here again, volatility remains escalated, and like I have mentioned in the March Magic WhatsApp alert, do be very, very careful, because remember, we are susceptible to any butterfly effect coming into place. Friends, the indices is done. I now come to the most popular segment of the market, wherein I give you 5 stocks of high beta, high impetus, where you take small exposure, wait for large price moves, and 5 stocks with low beta, low impetus, where you take big exposure, take money on small price moves. Different traders have different game plans, different attitudes and aptitudes, and therefore strategies differ. So high beta, high impetus stock list is led by PI Industries, number 2 Coromandel, number 3 Deepak Nitrite, number 4 NAM India, and number 5 PEL. The low beta, low impetus list is led by Biocon, followed by Gujarat Gas, Power Grid, Aisha Motors, and Motherson Sumi. Friends, this hierarchy of stocks changes from day to day. Do connect with me on social media. My contact coordinates come on the fag end of this video so that we can update each other. You can follow my very simple, easy to understand statistical output from our in-house derivatives, statistical trading model, the IBEX, which even a 5th standard school child will be able to decipher very, very easily. So I can help you become much better and profitable traders in these tumultuous and challenging times of high volatility. Only you need to connect with me on my social media accounts. Friends, before I bid goodbye to you, let me remind you to subscribe to my YouTube channel. If you haven't already done so, click on the bell icon to receive instant alerts about fresh videos being put about here. Good, bad, or ugly, your comments are always welcome, and do help me reach out to fellow like-minded investors and traders by referring my videos to your family and friends. Also, in the description below this video is a hyperlink to my playlist on Equity Masters YouTube channel. Do subscribe to that channel so I can share a couple of trading ideas every week as I do that. And there is a offer of a free PDF guide from Equity Master as to how to become a better trader. Do avail of this offer as well. I thank you for your patience in watching my video. Till we meet again in my next, this is Vijay Bambwani signing off for now. Have a very, very profitable week ahead. Bye-bye.